Okay, let's turn our attention right now and take a look at the bigger picture. Rebecca Walser is with us, President, Walser Wealth Management. First, I'll start with the weak data out of China, and we also have fresh warnings about U.S. banks, with Fitch talking about the possible downgrade of some of our biggest banks. This is pressuring our entire market here.
This is what we've been talking about, Nicole. This is where we're at. This is a global situation. China, deflationary real estate bubble collapsing potentially that could really impact their situation economically. And then how are we going to continue to get what we need from them? So there's a big concern about China. It's a symbiotic relationship as much as they're wanting to topple America and take control of being the top country. We are still in a symbiotic relationship. So as they go, it does affect us. It does impact us. But, Nicole, it doesn't surprise me at all that Fitch is giving these warnings about the U.S. banks. I have been saying the banking crisis is not over. We have a liquidity crisis. We have an M2 money supply contraction through July that is recession depression levels, 4.8% year over year contraction, tells us that there is a liquidity problem. When you have quantitative tightening on top of that to the tune of $100 billion a month, the Fed has to do something. They have to help. This is a stimulus-based economy. And when the stimulus stops, the world stops.
Right, understood. There's so much to sort of break down here, but I know you have your eyes on a meeting in South Africa. Tell us a little bit about that.
So this is the annual BRICS summit, BRICS, Brazil, Russia, India, China, South Africa. We have over 45 nations that will be in attendance, and over half of those have made formal applications. We're really looking specifically, we don't see a formal application from Saudi Arabia, but we know Saudi Arabia has already joined the Shanghai Corporation, so it's not like they're sitting on the sidelines just staying to the west. They are definitely moving towards the BRICS bloc, and the UAE, which is a huge, obviously important group, and OPEC, is also moving towards the BRICS bloc. So this is just a really trying time, Nicole. This meeting that they're having in Johannesburg on the 22nd through the 24th is them saying, how can we bilaterally exchange amongst our members? So if you have 40-something members of BRICS eventually, when we get to that, you're talking about the GDP of nearly half of the world potentially having conversations moving outside trade of the U.S. dollar. So this is the end of dollar hegemony. Yeah, Nicole, go ahead.
Yeah.
Sorry.
And look, I mean, I'm so happy you brought this up, because when you talk about the BRICS, group, right? Russia, India, China, I mean, right off the bat that they have their own collaboration that happens, and Russia and China are not necessarily our best friends these days. Right. I mean, they practice together without us. So it is worrisome. And, I like to think of the U.S. dollar as the world's reserve currency, and that's another topic that people are always concerned about. It certainly seems like it's staying that way, but it is a concern. Tell me what you're telling clients to do right now. You have a market that goes back and forth. You have the VIX creeping higher. We're down 2 of 3 days in the S&P, but it's a winning year. What do you tell them?
Well, I don't think that the fundamentals, Nicole, it comes down to fundamentals. Always go to the fundamentals. The fundamentals can be manipulated and they can be fooled for a while, right? With the stimulus from 2020, we could get through the system and deal with that for a while. But now with the Federal Reserve in a negative interest rate situation on a monthly basis, and with interest rates so high, and with liquidity drying up and quantitative tightening and the M2 money supply coming down and lending lending has gotten so tight. So now you've got corporations that are not going to be able to refinance when they have to. And this is where you start to see the beginning of a recession or depression. And I hate to say that, Nicole, but we have to call a spade a spade. This is the reality that we're dealing with, and we have to go back to the fundamentals. So I don't expect us to end the year to the positive as much as NASDAQ has done well, as much as S&P has done well. I do expect disruption for the rest of this year, and we're starting to see it now. We've already started to see the labor numbers turn softer. And so all around, we have got on all fronts, Nicole, major challenges. So I tell people to prepare for potentially disruption, big disruption ahead. And until we see the fundamentals showing again that we have liquidity in the system, that banks are lending, that people are optimistic, and it's not just all, this pipe dream of everything's going to be fine because it's the US dollar and it's America, then we can't go back to kind of a normalized situation where we're really ready for bracing for problems.
When do you think it's time to get in on the financials, if at any time? I mean, I had a guest today who said he liked financials, he liked industrials, but financials and healthcare. And I asked him, and he said he likes the big money center banks. And at the same time, I know the regional banks have had a hard time, and we actually saw Moody's downgrade 10 of those smaller names, but keeping some of the others on watch. And now Fitch is putting some of our banks on watch. I mean, would you ever go into the financial sector and say this group's a buy?
Absolutely, but not right now, not while we're in the middle of a transition. It's a transition period, Nicole. We just had FedNow launch in July, and so the digital dollar is not being talked about yet, but that is the precursor to digital dollars, the platform for it. I like the financials. You can see JP Morgan did really well when they acquired, SVB. We can see that, the bigger banks are acquiring some of the regional banks. That can make a quarter look really good until you start to realize, well, what was the problem with the bank? And now we have to deal with the actual problems of that acquisition and working through that. So because we're in a period of disruption, especially financial disruption, currency disruption, the financials are not my place right now to go. I know that central bank digital currency is going to upend banking, so we have to think about that long term as well, Nicole.
What about the Magnificent Seven?
Well, what can I say? I don't know. I think that we just have to brace and wait till this all plays out. And people just need to understand this is not a normal market, Nicole. We just have to be prepared. This is unusual things happening. And people want to say this is normal and it happens all the time and the market comes back. This is not normal. These are not normal circumstances globally.
Yeah. How about in a year from now? Do you think that the picture will be better, even maybe that the Fed may cut?
I think that we're talking about dollar hegemonic disruption. And so the Fed is going to have a lot of work to do. I just see that I do think a year from now, we're going to be in a much different place. And I think it's going to be a better place, but it's going to come after a lot of pain that people are not prepared or expecting. I hate to be such the doomsayer, but I just read the numbers. Like, I'm a numbers person. I'm a data person, Nicole. If the data says this is where it's going, I have to follow the data. And we have just all fronts that are just on the negative side. We don't have a lot of positive winners that are bringing us up. Even the labor market is now turning, which was the one stalwart that Powell's been relying on to do these 11 hikes, since he started on the hiking mission. So everything is saying be cautious, take precautions. But next year, I think we'll be in a much different place after the pain.
Right, understood. And when you think about investing in fixed income, I mean, obviously you're seeing rates on the rise, or they've been higher. And look, even the 10-year, I mean, we're seeing it, 4.2 today. It tells us something, right? Somewhere to put our money.
Well, it's the inverted yield curve. This yield curve has been inverted almost as, that's a tell right there. So long-term money paying less than short-term is a problem for sure. Yeah. But the 10 is coming up, so that's good.
Right. And look, if you have money markets and all that, you can make some money. But to your point, that inverted yield curve, and in a big way. Not just an inverted yield curve, but a hugely inverted
and that's why the banks are getting that's why the banks are downgraded, Nicole. Right. That's why they're potentially getting downgraded, because they borrow on the short term for these loans, and they lend on a long term. So you can't lock in long term lower rates that you're earning when you're paying out higher rates on the short term. It's a problem. It's a big problem for the banks, and that's the banking risk right now.
Yeah, it's like the 70s. We're back to the early 70s.
It is.
Rebecca Walser, thank you. Walser Wealth Management.
You, Nicole.
Thanks so much for being here.